Hello, everyone, and welcome to TEP Talks Professional Series, a groundbreaking new podcast dedicated to showcasing the diverse career journey and professional accomplishments of TEP alumni, brought to you by the TEP Foundation. I am your host, Stan Silverman, URI Class of 79, Tau Omega 402. It's my privilege to speak to TEP brothers across a wide spectrum of industries, gaining insights into their fields, advice for breaking in, and a realistic look at the day-to-day work behind some of the most impactful careers in the modern economy. Personally, I found so many of the brothers with whom I spoke to have such interesting stories. I'm sure that in addition to the educational benefit that you will gain from watching and listening to these professionals, the stories that they tell are just plain fascinating. So pick one, anyone, or pick them all. I'm certain that it'll be worth your while. Thank you and happy watching. Hello, everyone. Today, I have the privilege of speaking with Matthew Schiff. Matt is a financial advisor. So, without further ado, here we go. How are you today?
I'm doing well, Stan.
Good. Thank you. Thank you for coming.
My pleasure. What can I do for you?
So I read some of your literature and I had numerous questions. Why don't you first tell me what it is you do?
For 35 years, I've been a licensed insurance agent with securities licenses as well. But that's not my story. My story is that I run an insurance and compensation consulting company that works with the business owner, their executives, and their families to plan for all of life's what ifs tax efficiently.
Okay.
I've written tax law along the way back in 2003 and 2005. I grew up in the financial services world, couldn't run fast enough from my parents. My father, my mother were in the business. My grandfather was a Mutual of New York insurance agent back until he died in 1961. And I've taken a lifetime of skills that I've gotten technical side and married them with my, as I say to a lot of people, and I've been saying it because I'm doing other things as well. Tom Cruise and Rebecca De Mornay had it totally right in Risky Business. You've got friends. I've got friends. Your friends have needs, and my friends can take care of that. Let's put them together and have fun. Now, that could be any business, right? It wasn't he was in the young entrepreneurial, what was it, the young entrepreneurial club for his school? We grossed $3,000 in one night.
Wow.
No, don't you remember that's the line from the movie back in the 80s?
Yes, yes.
That's how I run my business. I put the people that I've known together with people I've gotten to know over time, and we enjoy the work that we do. And I say, oh, by the way, you're an accountant, you're an attorney, you're an architect, so you build stuff. And I have a builder over here who needs an architect, and I have an artist over here who has art that likes to work with a family office. The family office is dealing with the psychological issues of dad who got remarried, who was passed down some money along the way. So it's all that stuff.
Okay.
And by the way, I like the pin on your left collar.
Oh, yes. It's a family heirloom. I have two uncles and a cousin who were TEPs. So thank you.
You're welcome.
You went to Tulane?
I sure did.
When did you graduate?
I graduated in 1989.
Where are you from?
Originally from New York.
Okay. Where?
Manhattan, 16th Street between 5th and 6th.
Okay.
Moved from there to Connecticut when I was 11, a year and a half before my bar mitzvah, so it created all sorts of trouble. And had my bar mitzvah in Stamford, Connecticut, and then I went off to prep school. So,
okay. So, in reading your literature, please explain to me. So, there's term life, there's whole life, there's universal life, and you get into single premium life.
There's whole life, term life, variable universal life, indexed universal life. Those are individual products that you would buy. Those are the types of what I would call chassis. Okay. So each chassis or each engine does different things. They're built differently. One goes 0 to 60 in 2 seconds, like a term insurance policy says, hey, if you use me, I'm going to give you a moon rocket because I'm going to give you the ultimate payout. Whole life is like, okay, it's a nice V12. Takes a little while to get going. Okay. There's a lot of cost to it and it builds up. And then you've got everything in between. That is like renting an apartment, or it's like a mobile home. You own the mobile home, but you got to rent the land that you're on. So it works the same way. Individual or single premium is the difference of a corporate owned life insurance policy versus a bank owned life insurance in terminology. And corporate means I'm going to do multi-year pay versus single pay. Banks have a tendency to do single pay, which fall under 7702A, under a technical term, IRC 7702A, that says if you violate the net amount at risk rule between premiums and a death benefit as a formula of age and cash value, that's the single premium. So it'll be taxed as a modified endowment contract if you do a single premium. But it's a wonderful tax advantage asset because in the case of Bank of America, Wells Fargo, JP Morgan, any of those banks that are major banks, they own about 20 to 25% of their tier one capital is single premium. It's just like they bought a bond, except as Susie Orman explains it, you want to buy term and invest the difference. The difference was she didn't realize that the buy term, the wrapper should go around the investment instead of being separate. And in a banking world, by putting the wrapper around it, I may get 5% on my cash at a bank as a single premium. The tax equivalent is roughly 7.25 in a 24% tax bracket, right?
Okay.
It gets grossed up. So now on top of that, oh, by the way, that's just the cash return. Net after tax return, each and every year I'm getting that 5%. On top of that, I may have a death benefit that's 2.5 times what my cash value is. And
Okay.
that's like, oh wow, I got term insurance on top of my cash. There's your buy term and invest difference. So that's your single premium scenarios. But you'll never want to take the money out and withdraw it because if you do, it's taxable at the normal income tax rate as well as a 10% excise penalty. It's a balance sheet asset that I could go to the bank, go to the feds and say, hey, by the way, I got $3.5 million of cash here, but it's going to cost me a 35% tax hit. Can I take some Fed funds and go against that? And that's what banks do all day. So
Okay.
I just made your head spin, I know.
Yeah, you did. Okay. So, okay, I understand I owned a small business, so I understand buy, sell life insurance. So you and I are partners, and your wife is your beneficiary, and my wife is mine. I die. You don't want to have to do business with my wife who's never been inside the business before. So there's a life insurance payout that she gets. Bye bye. Thank you. Have a good day.
Yes, but really what you want to do in that scenario is instead of my wife having the life insurance on me that you own and pay, okay, you want to take that as a death benefit to you and buy back my shares because you get a step up in basis. If she just got the death benefit without getting that transaction, you miss your step up in basis. You see what I'm saying?
Yes, I understand that. So So now with your single premium for banks and corporations, so you want to insure your CEO and COO, all those C people. So now I say I want to do $5 million or whatever it is, and we you figure out the single premium. How does okay? I have a whole life policy with Northwest Mutual that aside from anything, I paid $159 a year since I was 19.
Right. And as long as you continue to pay it, it continues to compound with the interest and it continues to grow exponentially. The only issue with Northwestern Mutual versus a Penn Mutual, a Mass Mutual, or a New York Life is the direct recognition that if you go to stop paying it and you let them pay the dividend and the dividend goes towards paying the premium. Yeah, so at
Dividends.
Northwestern Mutual, if you stop paying the premium and now if you paid premiums via a loan instead of dividends to pay premium, the loan compounds and reduces the dividend that you'd get on their policy, unlike the other carriers where it's just a stacking. They do a stacking like a loan, have the dividend no matter what. The dividend doesn't change because you have the cash value, but it's unfortunate because Northwestern Mutual hampers you long term if you decide to use it as cash.
So the policy I have that cost me $159 a year. So I'm now 69. I've been doing this for 41 years. It's now
Right.
worth $51,000. And if you multiply 159 times 50 years, it's like $18,000 or something
Right.
silly like that.
That's why it's so great. As long as you continue to make that 159, it is the best company out there from a compounding because you have a guarantee that's probably above 4% on your product.
I don't know. I'm sorry.
Yeah. Oh, I can tell you that your guarantee in your whole life bought 60 some odd years ago, as long as you continue to pay it was great. My mother did the same thing for my sister and I with Mutual of New York. My father ended up becoming the president of Mutual New York and walked away from Mutual New York because when they decided to go public back in 1990, the person who was his number one said, "Oh, you'll make tons of money." He goes, "No, no, no, no. You're stripping the money from the policyholders by going public like that. That's really wrong to do. I don't want to have anything to do with it." And it actually impacted every single whole life policy, including the ones that I owned with Mutual of New York. And exactly what I talked about was a direct net recognition hurt the policy itself. So yes, if you're going to continue to do it, this is a policy that if it's truly a gift to your family down the road, pay the 159 every year. Don't think about it and keep it in force. That's what I would, again, I look at things holistically. I don't tell people change things, but I understand the carriers. I know where they are.
So thank you. So now we buy a $5 million policy with a single premium on one of our executives. In my case, Northwest Mutual, so you're saying guaranteed me 4%. So when you sell the single premium, because you were talking in the example that's listed on the website, I think it was a
Yes.
5% return.
Yep.
That so that's what it's paying today, or
Cash on cash. Today it's 5%. It fluctuates according to the market. So I literally get monthly returns from the carriers, and I have 9 carriers that I have host our meeting it down in New Orleans, ironically down by Tulane, where a professor is actually one of our keynote speakers. He was my professor my senior year. He's about to retire, so I think I'm going to lose my speaker going forward. But that being said, the carriers come out every single month and tell me what their rates are, or every quarter. On the anniversary date, depending on the insurability of the person, we could move the money or not. I don't make, a huge commission on this. I make 10 basis points. I make 15 basis points. If I if I make a 4% placement fee on 5 million or less, that's a lot of money. But most of the time it's a 1% placement fee or less that I do in that world. In a standard term insurance policy, yeah, I'll probably make 50% of the commission with some overrides and, expenses and stuff like that. That's standard insurance. But this is totally reverse engineered. Right now, I spoke to an attorney and two senior partners in an architectural firm. They have 120 employees. They have two people, 73 and 74, who are getting close to retiring and they're worried about buying back their shares. So, what we did was we have a guarantee issue product on everybody 65 and below. Simplified issue, everybody 65 to 75. Means seven deadly questions. Are you, have you been at work for the last for the last 90 days? Have you been out of work for 5 days or more in the last 90 days? Have you had a stroke, coronary artery disease, cancer? And if so, what type of cancer and how long ago? These are the types of things. They go from there. If you don't get the knockout questions, we automatically give you a coverage without having to have a medical. Great, no problem. Jet issue. And then it comes, well, I've got 19, I got 21, I might have 14, I might have 10, depending on how many people meet the criteria. But as an aggregate, the company provides the benefits because it's deductible to the company when they go to pay the benefits out, and they use the asset that is a tax deferred asset on their balance sheet, grows tax deferred, comes in as a tax free death benefit to the company, and they get to pay a deductible benefit that's taxable to the participant. So they do a net, fully cost recovered wash expense item when they look at this on a net present value basis. And that's what we talk about.
So when you said they give the rates on the anniversary dates of the policy and then you can move money around, did you mean between carriers or you get to choose the investment within the policy?
Depending on the different product that you're using, whether it's an indexed chassis where you can move between the different indices inside the carrier, because there are institutional products where I can go into an indexed universal life product and say, I want to be in the S&P 500, I want to be in the Russell 2000, I want to be in the Dow. I want it to be a 1 year index. I want to be a 2 year index. I want it to be a 6 year index. Those are the institutional products that are out there that are single premiums for banks. They stay within the carrier. That being said, just like real estate, you can do a 1031 exchange and go property to property, like kind, and you can do the same thing in an insurance contract. Now, the downside to that is carriers give you a limitation on how many times they can do it. There may be a surrender fee. In fact, you can always surrender the contract for the taxable consequence. But to do a 1035 exchange, they usually have a penalty. So it's like, okay, I've got $2 million in there. It's going to cost me 10%. Oh shit, it's going to cost me 200,000, excuse my French, to move my money. It's not smart for me to do that for an extra 10 basis points. But some carriers, and I've had it over the last 10 years, come back to me and say, hey, by the way, are you still in your surrender charge? Yes. How much is the money? Oh, we got $20 million we're going to move. It's a 10% surrender charge that's still on here. That being said, we'll bonus you that extra 10% on the deposit. So we'll make you whole. Do you have a problem with that? They go, okay, no problem. I have that. Okay, what's your rate of return right now? Great, I like that. And why are you able to, then they ask, why are you able to do that? I say, because the carrier you're with is the tail wagging the dog versus the dog wagging the tail. And they go, huh? I said, the tail is wagging the dog at the old carrier because you bought a policy that is getting crediting rates from 3, 4, 5, 6 years ago. It's a general account product. versus this other carrier is a new money rate product. You remember where rates were 2 or 3 years ago? They were at 2%. Do you want a 2% rate of return or you want the 6% rate of return I can get you today? That's the difference. So
Okay.
it's a good conversation.
What is your degree in?
Economics.
Economics. And then I'm assuming you went back for um, uh, insurance degrees or certificates.
I have a master's, they call them certificates in I have a CLU, a CHFC, a WMCP. I was the past president of the Alumni Association of the American College of Financial Services, which is Huebner, who put the whole educational process together for financial services industry. Prior to CFP saying do no harm, Huebner said, if we're going to be in the financial services world, you need to work like a doctor and be a practitioner and do no harm. Do what's in the best interest of the client, regardless of the product. So you analyze products, you analyze the plan, and you pick what's best for them and you design it what's best for them, not what's best for your pocket. And I've been doing that for 35 years.
Are you a fiduciary?
I act as a fiduciary, but only in certain instances am I a fiduciary. In life insurance, you're not considered a fiduciary, but I am an RIA and I have clients who I treat and handle their portfolios as an RIA.
RIA means
Registered Investment Advisor. And there's another title called an IAR, which is an investment associate representative that is part of the RIA. So the individual rep is an IAR working for an RIA. I know it gets.
okay. So
I can have you in about 2 minutes, not even. I can send all sorts of nomenclature and different acronyms that 99% of the world has no idea what I'm talking about, but they all mean something to the financial services world.
why did you get an economics degree as opposed to accounting or insurance?
Well, since I went to Tulane and I was initially on the pre-med track and literally changed my track the first week of my junior year to go toward, and that was my decision point.
With your economics degree, you came into your father's business, or he said,
Circuitous route. Dad
okay,
had me learn the business when I was sitting over the kitchen table, hearing mom and dad talk about what was going on. Dad would come home literally at 1 o'clock in the morning on New Year's Eve after closing the business, not because they were out partying, but back in the 70s, if you were doing qualified plan work, as long as it was stamped by 11:59 on December 31st, it met the year-end deadline. And that's the way my parents worked. And so I then was asked when computers came along, do you want to come in and learn how to key in data and use a computer for us? Because we're not really good at this. We'll teach you financial services. You teach us computer stuff. So
mm-hmm.
we worked together on that when my parents, I guess I was 13, started working in the summers. I would spend every morning from like 7:30 with my father in his office until 11:30, 12 o'clock, catch a train, I would go from Darien, Connecticut down to Greenwich, Connecticut, not very far, but my parents were working, so hey, catch the train. It's easy. It's public transportation. You can walk. And then I'd go and I'd do what I love to do, which was sail every afternoon and learn how to race sailboats. So I learned the family business and then took that into college. And dad said, oh, well, you're going to college. You should be taking insurance courses. You should be getting your CLU. I said, Dad, I'm never coming into the business. And while I was the bursar of the fraternity house, my dad was also a TEP, and he was at the national meeting representing his alumni chapter, sitting in the back as part of the alumni board. And I stood up talking to I think it was Kirkland at that time was our insurance guy for TEP. And I said, What is it with this property and casualty insurance? It goes through the roof every single year. It goes up by 10 to 15%. You guys are crooks. And my father's going, oh my God.
And their answer was,
We said their answer was, if you remember what was going on, if the fraternities weren't stupid, like KA was Rusty Combs, where the kids were jumping in the back of the truck and another kid jumping across the front of the bed of the pickup truck, pressing down on the gas pedal and causing an accident where the kid ends up having a brain trauma that basically was going to make maybe $50 million in his lifetime. And now we have a claim that we have to pay out. That's the reason why your insurance goes up. And that's what he said to us point blank.
mhm,
It was like, wake up, boys. If you don't realize what you're doing, this is what's going to happen,
okay,
which was actually a very good thing back in 1985, 86.
I
You know,
see. Yes,
we were all living through Animal House was the greatest thing. And everybody can do everything that Animal House did. The best thing is there were no iPhones, there were no web cameras, there was
yes,
no internet,
yep,
and no one could video our stupidity immediately. They had to actually bring a video camera to the table.
yes,
So my
yep.
stupidest moments were never recorded.
Thank goodness.
Right. Our kids are not so fortunate.
No, they're not. They're really not. So you do insurance and you also do in investments for people, correct? Or is it always tied together?
No, it's not always tied together. Really, what we're doing is we have a thing that's called the perfect plan. And our perfect plan podcast, which is registered trademark, talks about how do you want your financial life to look like? That is your perfect plan. And when we went and registered this with the Trademark Society, we explained to them it's a process. It's not about a financial product. It's about how we go about it. It's about what the end goal is of the client. And it could mean all of these different things. Our podcast discusses that. And I want to register that because they're like, well, we can't register your financial process. I'm like, that's understandable, but you can register my podcast that discusses all of that. They go, oh, absolutely, we can do that.
Right.
So that's how we got our registration done.
I've met different kinds of financial people, and they're um, like somebody who worked for David Lerner
Okay.
or Edward Jones, and you hand them $100,000, and they tell you that there's a 3% commission, and so now you have $97,000, and then they invest it in sometimes their company's products and sometimes not.
Right.
Or there's the other guy who you give him $100,000, like I think Fisher does it this way, and you pay him 1% a year, and he tells you that when you make money, he makes money, but if you lose money, he still gets his 1%. So, which is the better way for a person to go?
Well, the, the best way to answer that is it's a math equation,
Yes,
right? If you're going to be with Fisher for 20 years and you're watching your portfolio go from 10 million to 20 million or 5 million to 20 million over those 20 years, he makes 1% every single year of those 20 years, right?
yes,
He's at 200,000 comp in the 20th year. He made 50,000 in the first year, but he made
yes,
50 to 200 every single year. On top of that, is it in a taxable investment or a non-taxable investment? We haven't even discussed that yet. What's
okay,
happening to your capital gains? and your dividends that are recurring. I mean, that's part of your whole investment. That's a that's what I call drag and noise on your
Okay.
portfolio, right? Now, if you know you're going to be in this for 5 years, 10 years, 20 years, if I told you that my total all-in cost in a life insurance policy over 20 years was that same 1%, but that you could access your money without ever paying dividends or capital gains, which is better? And that's the same dollar amount.
Okay.
That's what I talk about. And I
Okay.
and I know I know Ken personally. Ken keeps his camp one camp over from my father's camp in California. They're members of the same club.
Okay.
Ken is a big, big time uh, arboretum guy. He loves nature. He does a lot of give back to California redwoods and all that stuff. He also, over the last 15 years, went from being about 350 pounds to about 150, maybe 170 pounds on, GLP-1s. He's cleaned up his health, but he hasn't cleaned up how he manages the money for his clients, is what I'm going to tell you. Because the portfolio at 1%, the world doesn't work on 1% anymore. The world works on 0.5%, it works on 0.25%. And when I work with, like, as an example, Mass Mutual and New York Life own 4 billion. That's with a B, like billions, like SAC. They each
Hmm.
bought $4 billion worth of corporate owned life insurance, single premium. Each of them bought $4 million or $4 billion. That's assets, cash on cash. The reason why? Because they're risk based capital and the way that it's accounted for on the balance sheet is better by having the wrapper, the insurance, Susie Orman's idea, around their investment because they're getting a 5% cash on cash return, which is just the mutual fund or ETF or ever insurance directed fund that they were going to hand to the money manager. The money manager was going to get his 6 bips, which is usually what it is, to
Hmm.
manage their $20 billion or $4 billion or $2 billion. And the insurance cost is literally 10 basis points for the total insurance. It's six basis points for the investment management and 10 basis points for the insurance. But oh, by the way, at 16 basis points, they're dying to get into it because they get zero tax versus a 34% tax.
The guy who charges the 3% claims that he buys a different level of stock or investment than
The 1% guy, if a
yeah.
3% guy, that could be an annuity guy. He could be doing the single premium, putting the money in. He'll just get a service fee on the back end, or what they call 12B1 or management fees.
Okay.
And that management fee might be the 10 basis points that I talk about. But he gets a
Okay.
placement fee up front and a small management fee. And that's an alternative to a asset-based trailer. In a qualified plan, if you go into your 401k, the standard fees were usually ranked as 1%. It used to be 1.5 for the small plans, 1% for the bigger plans. Today, small plans are 1% fees. Small plans are between 35 and 50 basis points. Some are smaller at 25 basis points when you get over certain hurdle rates. But it becomes a smaller and smaller fee. So Fisher saying 1%, if I'm at 5 million and I go to 20 million, he better put me on a scale where I get to 20 million. He's only getting his $50,000 again. He's not doing better. I'm doing better, but he's getting the same management fee. If he doesn't want to do that, I don't want him as my manager. You see what I'm saying?
Okay. Okay. What's the difference between a qualified and a non-qualified?
It's a term of art by the government. Qualified means you're putting money in on a pre-tax basis into an IRS qualified tax deductible trust. When that money goes in, you get a deduction for putting the money in. It grows tax deferred and then comes out on a taxable basis in the future. Non-qualified means it's a promise in the future, or non-qualified means it's after tax and monies are held at the company level and the deduction is paid in the future, not today, but the money grows tax deferred. And it's a term of art more than anything else. So NQDC, which is a term, non-qualified deferred comp, means that it's anything above and beyond what you can put in legally into a 401k. So as an employee, I can put in 24.5 into my 401k today if I'm 50 years or younger. I then get a catch-up. That catch-up amount is legally allowed to be put in. The government also says the employer can put in a matching contribution as well as a profit sharing contribution. All of those contributions have to be proportional. I can't give you more than I get on a proportional basis. If you make $2 million and I make 200,000 and I want to put 10% in, I have to do the 10% in equally across the 2 million and the 200,000 person as a percentage basis. That's the qualified plan. In a non-qualified plan,
Okay.
I can discriminate. I can pick and choose who I want to give the benefit to, how I want to give the benefit to, and when the benefit's going to come due. The qualified plan also requires you to vest the person in the employer contributions for some period of time. And that is either 5-year cliff vesting, where no one gets any of the employer money until after the 5th year, or you can do it as a scale, 20, 40, 60, 80. That's very standard. People are used to that. In a non-qualified plan, I could say, you know what, Stan, I don't like you. I don't want to give you access to this money until you get to retirement. And on top of that, you have to not only get to retirement, but you have to be in this plan for no less than 10 years. And you have to work for the company for no less than 20. If you don't get to that, you get nothing. Meanwhile, I happen to like your brother-in-law. Really, I like him a lot, and he's doing a lot for me. I'm going to go put a profit sharing plan in that every single year that he makes his number, I'm going to give him 100,000. And even if he decides to sleep through his job for the next 6 months, I'm guaranteeing him $50,000 bonus into this plan. Hey, is that fair? No, it's not. But it's non-qualified. I can do that. I can pick and choose.
Okay.
Now he can't touch it until I tell him he can touch it. And when I do that, I can tell him, hey, by the way, your brother-in-law, he can touch it in 3 years so that he can pay for his kid's education. And the reason why I'm really doing this is because I think my brother-in-law is a total idiot. Meanwhile, I think that you're going to take care of your kids, and I got to make sure that my sister's kids are going to college. And that's why I do it. So I'll give him access
You
to
have to
this.
set it up like
I have to set it up before I give the money, but I can do it by person, by class, however I want to do it. It's a non-qualified promise to be paid in the future. And I don't have to put money aside, but if I do, there are certain rules of how I do it. And when you are
okay.
able to get the money, the triggering event is very specific on how it happens and how I can pay it. It's called the time and form of payment. Ironically, I helped write these rules and I explained to the government, you can't do certain things. People can't do this. They are not able to manage this. This is not going to work for you. You want to do this? You're catching the baby with the bathwater. You're throwing all the water out, but you caught the baby. That's not what you want. So, I mean, in that manner, what I really am to everybody is I'm the interpreter between the employee the company, the investment, and the insurance company, and all the advisors that puts it all together in a manner that makes your perfect plan fit your goals, cash flow, and structure. And it's funny, it's taken me
Okay.
30 some odd years to get to this point where it's a very concise conversation with so many options out there. I mean, when I walk somebody through a decision tree as a business owner like you, when you started your business, these are the questions I ask. What was your goal? Shit, the first thing I'm worried about is I got to pay my bills. I got to eat. You know, I'm not worried about
Yes.
what's going to happen in 5 to 10 years. Now you get the car, you get it rolling. It's like the flywheel concept that they talk about in those books. Well, yes, some of this stuff goes on autopilot, but how many doctors really run a medical practice like a business? They're good at medicine, they're not good at running a business. Same thing with dentists. They're great dentists, they're horrible businessmen. They don't put money aside. We show them how to protect themselves from themselves. And we interpret what's out there today and do it in a tax efficient manner based upon what they're trying to do. Because if you look at a qualified plan, the government back in 1973 recognized that, hey, by the way, if we can get everybody in these plans and getting them to save themselves, we don't have to put money aside in an aggregate that could create a big problem in case interest rates go awry for us. But at the same time, these qualified plans, you get a pre-tax deduction going in. Which would you rather have? If you're a farmer, would you rather pay the tax on your seed or on the crops that you sell?
The
A fa-
feed.
right, the seed. I would always love to pay the tax on the seed. My problem is, as a farmer, I'm taxed on my crops every single year unless I can find a way to put the crops inside a tax efficient wrapper, right? Same thing happens
Right.
with every single investment. A life insurance policy is like a Roth IRA. If you can get close to the $100 or $100,000 that you were putting in year one without that 3% fee, you didn't take a haircut on buying it. But if you're buying a new piece of property and it's $100,000, don't you think you have some sunk costs that the property is probably not worth 100,000 when you buy it because now it's worth 95 because I had to get title insurance, I had to get a mortgage, I had to do this and that. It's a little bit less than what it was, but I know that this $100,000 property in 7 years is going to be worth 200,000, and I'm going to pay capital gains on
Yes.
it, not ordinary income. Same thing happens inside the insurance product, and that's the way people don't think of a product that way when they buy it on a business side. Because I say to people, I can give you a 5% rate of return in a single premium. The problem is, if I do that, it's like having a levelized hot dog. That 5% will always be 5%. Versus if I squeeze a little bit on the front end, on the back end, what happens to a balloon if you were playing with a water balloon? It pops and it becomes really big, right? You end up with this huge amount. Well, that's the way an actuary squeezes an insurance policy. He squeezes a little bit from you and says, hey, by the way, you just bought this house. For you to do this, it's going to penalize you to surrender this or move. But you wait 3 or 5 years and oh, guess what? I'm going to give you this huge balloon of cash on the back end and give it back to you. And that is the difference between a single pay and a multi-pay that we do, either on an individual or a corporate basis. And we design products by reverse engineering what you're trying to accomplish. I had one client, and this is really where the whole conversation comes to. It's a great way of bringing it all together. I have a business owner. He has 20 employees. They're all 1099 employees. He's like, I don't want to pay them a benefit. I don't want to do a 401k. and I can't put enough money away for myself. He has his financial advisor, who came from his father, said you should be doing a Roth IRA, or you should be putting an IRA in for yourself if you want to get a deduction. Maybe even a SEP. But the problem is, if you do a SEP, you got to give everybody else who's the 1099 employees the benefit of it. I'm like, you're right. Let's just do the IRA and look. So that's $500 a month. I said, but really, you make money in chunks. You'll take in a $20,000 hit here, $20,000 hit there. You live your lifestyle on $10,000 a month of cash flow, but you make $450,000 a year. Wouldn't you like to just have like two lump sums a year and say, I have flexibility to it, and I'm putting this money aside and it'll do three things for you. One, it'll give you a retirement asset that you'll put in like a Roth. It'll grow tax deferred in all the mutual funds. We could even put it in an index for you. It will have a life insurance component that'll be part of your overall life insurance portfolio, not all of it. And lastly, it'll also give you a long-term care benefit, which you have had a back issue. This is a big thing. The first year that you put it in, that $30,000, because you're minimally funding it, will only have about $10,000 of cash surrender value. However, if you put in 150,000, you'll have 140,000 of cash. The reason why is there are fixed costs on this thing to implement the first year.
Sure, they need to be paid off, and you pay
In
them
the
off the
first,
first
yeah,
year.
exactly. Because we're buying and I said, this is a permanent insurance policy. My commission on this is not 100%. I've dialed it down so that it's an investment. It's down at 20%. But you need to know that these are fixed costs for doing this. 9 months into it, he goes, what's my surrender value on this thing? I said, listen, what's going on? He says, my father's health is getting worse. His investment advisor is saying, you don't need to be putting money aside. You're going to inherit all this money. I said, well, based upon what you're telling me, that you want to now just put $500 a month and never do anything more, I suggest you surrender the policy. I would never have recommended you do that because you gave me a whole different set of facts. You gave me a set of facts that was 1/5 of your cash flow and 1/15 of what you were anticipating originally. That is malpractice if I was selling you a product like that and you wanted an investment. And I want you to know that. I want you to get out of it. My problem is I can't refund you because this was what you decided you wanted to do then. So now you want to change it? This is on you, not on me. He's like, but. I said, okay, yeah, it's an $8,000 mistake, but it's better than an $800,000 mistake. The problem is you're giving up something I don't think you'll ever get again. I got him a non-smoker life insurance policy with a 12 and a half, what was it? It was a $20,000 a month long-term care benefit for 2 years. Tax-free, that if he ever needed it, he had it. Plus an investment in there. That was going to give him, by putting in $30,000 for 10 years, he was going to get $55,000 for 20 at retirement and have all those benefits along the way. Now, the reason he was doing it is that's your $30,000 Roth IRA. Oh, wait a second. You can't do a $30,000 Roth IRA. Yeah, you can if you bundle it with life insurance.
Okay.
But that is a different design depending on, what their agenda was. So what we do is one of the other things when we do all of this, like our underwriting on this person, he has some health issues. So from a health issue, I have different carriers. There are some carriers that happen to like people who have high blood pressure. There are some carriers that like people who have breast cancer and are well medicated and well treated. There are some carriers that have an affinity for those who are have high blood pressure, different ailments along the way. This person with a sleep study, they're happy to take somebody who had, sleep apnea because they understand what that means. Also, there are other carriers that happen to like people who are in cannabis friendly states. But you cannot own the cannabis dispensary because that's ill-gotten gains. That's illegal money. So we can't insure you for that. It's crazy. Whatever.
So what do they have an affinity for it, or do they tolerate?
There are others. There's some that tolerate and some that have an affinity. There is a specific,
Really?
there's a specific carrier that has no problem with a person who vapes. He's a non-smoker. But if he uses flour, he's a smoker. And then there's other carriers that say you can have a gummy but not smoke.
Go back to the high blood pressure.
Yeah,
So there's a company who has an affinity, or they tolerate a person with high blood pressure.
they have an affinity for taking clients with higher blood pressure than others. So if I have somebody with like 145 over 110, a Mass Mutual, a Northwestern Mutual will say you're a table two, or a possible higher rated person. Versus I have a substandard carrier, but they've got a very good product. And that ABC carrier might say, you know what? We think this person could be standard and we might be able to even approve them to preferred. But their preferred pricing is only about 20% better than the rated policy from the good carrier, because if they had really good ratings and they were preferred at the good carrier, they would have saved money at the good carrier with the preferred rating. You see what I'm saying? I'm falling in that range. So, like John Hancock likes, um, John Hancock might take someone who's 5 years removed from cancer and give them a table B, while Mass Mutual would say in the same city, they're a decline or a table six.
Mm-hmm.
Well, I could go to a Pacific Life and they could say, you know what? We've got a program. Once you get to table four, you get standard. And then, based upon the product, I can basically reverse engineer it. I can blend it up and down and say, here's the full commission product versus a blended commission product. And if you did any reading, by the way, about Kyle Busch, and it was a big thing about Kyle Busch, how he said his insurance agent said, I want to sell you a policy that's paid for by the bank, that because you make so much money, all you'll do is pay the interest for a period of time, and then you'll repay the loan from the policy in the future. Problem was, to do that, you have to dial your compensation down properly. Otherwise, it chews the policy up. It eats it all up. You can't perform anything. And as I say, if you're going to buy a candy bar, the reason why you're buying the candy bar is you don't want the wrapper. You want the candy inside the wrapper. So the candy inside the wrapper should
Mm-hmm.
be the client's. The cost of buying the candy bar is the cost of the wrapper. But no one knows the cost of the wrapper. They just know the whole thing. And they say, okay, it cost me $2.50 for a candy bar, but it cost 50 cents for the wrapper to put it around the candy bar. I want the $2 worth of candy, but I got to pay 50 cents for the wrapper. No one knows the wrapper.
Right.
Imagine walk into hey, by the way, I come up to the candy store. I want this, I want the Mars bar. Okay, it's $2.50. Yeah, but I don't want the wrapper. That wrapper cost you 50 cents. That's what people are negotiating about all the time these days.
So is your industry getting harder?
Our industry, if you want to be a commodity salesman, you're going to be out of business in the next 3 to 5 years because AI will put you out of business because people will go on AI and say, find me the lowest cost insurance policy that fits my life. And you know what? 20% of the policies that are out there will be bought that way. And there'll be a large volume. The problem is, unless you're diligent about it, unless you share your plan with your family on what you're doing, it's never self-completing, I find. This person says, I bought these policies along the way. I don't know what to do with them. Half the time, most people have no idea about whole life, UL, VUL, IUL. They don't understand what they bought. When you bought a car, can you tell me how to build the engine?
Nope.
Okay. But if I took the engine out of your car, would you go anywhere?
No.
So your car is useless without the engine, right?
Of course.
Like my wife, I give her the keys. That's about the maintenance that she has. That's the problem. And that's the problem in most of the life insurance financial services world today. People don't understand the products they buy. They just know that that new hybrid car or electric car that they bought that was a Tesla, they don't know how to put it together. They just know it's broken. And it's their fault. And you know what? This is my money. And there's an attorney over here telling me you did something wrong. And I got the guy who's got the lemon law on this car and says, you know what? Just like the car, I can get your money back. I can get you out of it for free. And that's what you're dealing with in today's world, regardless of whether you're a product manufacturer or a service person. I say you either adapt in today's world, or as the kids who are coming out of college today are learning, you better learn the AI tools that will help you be able to transition and get ahead of your market faster than anybody else, or you'll be left behind. And I actually use a program right now, and my wife thinks it's hilarious. I've been using it for a month. I've replaced my SEO guy that I was paying $1,000 a month for.
Wait, what's SEO, please?
Search engine optimization. So when you go looking in Google, it ranks information based upon what people look for. AI has the same search engine optimization. So AI is looking for the same information, but they do it in a different way. AI engine optimization is the hottest way to get found. So if you're in ChatGPT, if you're in any of the other AI programs, they're looking specifically for information in there instead of going to Google. Because Google says, we've done all the scrolling. Here's the AI stuff that you need to know about, and we're going to put you together. I have 6 agents that now are my employees that I pay. And I pay it on a monthly basis, or I paid for it on an annual basis. One AI agent is my administrative assistant. She reads every single email, schedules all of my calendars, puts everything together, and says, guess what? I'm going to handle all of this for you. And before I send it out, you're going to get a chance to review it. Unless you tell me to send it, I won't hit send. I said, okay, great. Not a problem. Then I have Penny. Penny is my blog writer. Penny is in charge of my website. She goes behind the scenes and makes sure that Google and the other AI agents search my blog post properly, and all of my meta tags and all of that are perfectly done on WordPress. I'm not a software engineer. I fired that guy. This woman's doing all the stuff, loading it in there. So I've been doing this since 2006 on WordPress, but WordPress really does all of this, and you need to have somebody who knows how to use the latest tools. Well, the AI agents are picking up the latest tools and saying, this is where we land. So Penny, on a weekly basis, comes back to me and says, guess what? Out of a rank of 1 to 100, you're ranked right now 91.7%. That's pretty darn good for this. This is how we can improve you. And we're going to get this, this, and this, and this. Here are your competitors. This is where you're landing on the search. This is what we need to do, and these are the posts we're going to do. I'm like, great. I don't like this one. I don't like that one. But do this one for me. Now, she goes, this is what you're authority in. Let's double down on that. Let's take that material. Let's put it over here. Let's put it all together. Let's bring it together. Get this video that you've done, tie it together with this content from this, IRS blog or whatever. Bring in the actual stuff. Bring in the experience of what you've done. And now we've got a blog post that Sunny, my other person, is going to just give us a highlight and tie the visuals back to our webpage. Now, the problem there is Sunny has a tendency to get a little creative. And I've told Sunny, you're pissing me off. You're being too creative. I don't want you doing AI creative logos. You're supposed to just follow the rules that I've established. He goes, okay, my bad. I literally have gone back and forth with him. In the last 12 hours, Sunny has gone off the rails, and I've basically told Sunny, the last 12 hours of your AI, you keep having a problem, and I want you to go back to the way that we used to work a month ago. Which basically says delete everything that I've been working on except for the rules I have right now. And I don't want you to ever remember what we've been talking in the last week.
Mm-hmm.
Which is really kind of funny. Now, AI, my wife says, while we're sitting in bed, I'm doing all this stuff. And I'm talking to my Ava, who's my administrative assistant, Penny, who's my blog poster, Sunny, who's my social media, Stan, who's my outbound marketing guy, Linda, who's my legal associate who reads my contracts. And then I've got this other one who I don't talk to at all. And what she does, she's responsible for any incoming phone calls. So that's Rachel. I haven't hooked her up with my phone. She can do the AI answering in a very sweet voice that you wouldn't know it's an AI person. And depending on the question you asked, if you wanted a specific answer and speak to me, she would put you through to me. So I used to
Okay.
remember there was an AI that used to say, hey, I'm not available. Would you like to go to voicemail or you want to put the call through? And I'd say, put the call through. And they'd put us through. And that's what's going on. In this month alone, we're now 6 days into the month, and it's saying I've saved 25 hours of work from the stuff that they've done. Last month, they did almost 130 hours worth of work saved for me.
That's great. Wow, that's 3 weeks.
Yep.
So, what are the highlights of your profession?
The highlights of my profession. Let me respond to this guy, and I'll give you exactly
Go
that
ahead.
answer.
Go ahead.
The logo setting is turned on in Sunny's settings. If it is, it's best not to mention the logo in the chat or the guidelines, as that might confuse Sunny. We also recommend reviewing the guidelines from time to time to ensure there are no conflicting instructions. Please let me know if there's any further. See, I got a human response on Marbleism's support chat. I went into it. It's trying to help me through the AI, and I said, "This is what I'm having an issue with." Sunny is just frustrating me. He's going in circles, and they said, "This is what you need to know." And that was really cool. And they say, okay, here, this is what you need to do in case you have any problems. Do this. And now I understand exactly why Sonny was having his issues. You give a
So you
computer
get to
you
the
you you
bottom of it.
you give a computer conflicting instructions, it will run home to mama. Um, and we're going back to what was it? Matthew Broderick's War Games. Would
Yes.
you like to play a game?
Well, you have to be like James T. Kirk, who rewrote the program so he could beat the Mitsubishi or whatever it was called.
The,
Yeah.
it's the Mobahashi Maru.
Yes.
So the highlight of my career in the last 35 years. Truthfully, I'm not sure I've reached it yet. Um, Definitely for the fact that I helped write 409A and 101J 23 years ago and 21 years ago when I was in my 40s. Well, not even 40s, I was in my late 30s.
Hmm.
Um, that definitely set me up for the rest of my career. I became authority in the non-qualified space, working with companies, advisors, and clients to do discriminatory plans on behalf of the executives and their families. That's
Okay.
really what happened. Today, being the centerpiece of a larger firm of 100 firms that we're putting together, I'm finally plugging into a network that sees us as the centerpiece and the joint work partner. So,
It's quite
um,
an accomplishment.
yeah, yeah. And we're using the tools that we've had over the last 20 years and automating them with AI to create an app that I can now have the staff run this, where it doesn't take us a day and a half to create the model. It takes us 30 seconds to hit the button, hit the print button, and send it to the client.
Okay. When you have, so you have a pool of people, I don't know how many, let's say you have 1,000 clients. You don't write an individual investment plan for each of those 1,000 clients and then execute that. You somehow put them into groups like conservative, super conservative, fly by the seat of my pants investor kind of guys.
What happens is I usually have an RIA or an investment advisor who's managing the portfolio that I work with. That's one. And if I'm working with the client and they're working with that investment advisor, the advisor is in charge of each of the underlying funds. I'm in charge of the structure of the program, the tax efficiency, and all of that. So I'm always doing it in conjunction with another advisor. I never am alone. My client just doesn't jump in the boat and say, "Hey, by the way, I'd like to, buy a program from you." They're coming to us because they know somebody who knows somebody about us that wants to work with us. But more importantly, when we do this, we get the client to buy into the plan design. The plan design will grab a product that the product may be an investment features, it might be an insurance product, etc. Some of them might be on autopilot, which some clients say, "Oh, thank God I don't have to think about this." Others want to actively manage it. My insurance carriers want to specifically be able to move their money on a daily basis inside the directed funds. They want to be control of it. There are people who do that. And I say, guys, if we're doing that, we got to have a ton of money in there and they'll give you the ability to do it, but they're going to have a management fee inside there. Versus I can have it look, smell, and feel like your 401k, give your participants, which I've had doctors, the ability to save money in the plan and once a quarter or once a month move their money and reallocate it because we don't want them trading this account because they think they know everything about everything. And oh, by the way, the market's falling. Or Chicken Little said, Trump is saying one thing, the market's saying another, and I'm deciding to bet whatever way I want. And that's really a true conversation that happens all the time.
Mm-hmm.
Okay? But instead of you being able to move within 30 seconds, I'm going to protect you from yourself. We're going to make this a longer term play. It may take a little bit longer to move the boat. This is more like the QE2 instead of a Donzi.
Right.
You turn the wheel, the Donzi's going to move immediately. You get flipped out. The QE2 ain't moving so fast, but at least you know you're going to get there.
Mm-hmm. Yep.
And that's the way we work with it. I try to keep it to analogies so that people understand the tools that we're using because they're very complex at times. What you need to know is my fees will always be disclosed. I'll show you why, if we're buying a product, why the product makes sense and why you're paying for that product here versus you're paying a fee to go into a straight investment. Or why your insurance, if you were to do this, would be in this column, your investment was in this column, and in this column, your insurance only goes up in cost, and it will far exceed what your earnings might be here, and you may want to put them together so that they protect themselves from each other. People understand that type of conversation because I can promise you, when two brothers go into business together, they think about how much fun they can have. Then they get married along the way. And I can promise you, I don't want to be in business with my brother's wife, who's a widow. And she's asking me what the hell I'm doing, and I want to go on a vacation, and I just took $100,000 out of the company. And she says, "You can't do that. That's my money." Those are real world conversations.
Yes. Yes. So in my career, I probably made 117,000 mistakes that some of which I learned from and some of which I just kept repeating.
So,
Okay, so you talk about AI and you're going to lose a portion of your clientele and your business out there. I lost a portion of my business as the growth of the internet. And there were times when I had people walking by. I was selling Citizen brand watches at 30% off. And I had people walking by talking to each other saying, I bought mine at 50% off. And they didn't even give me a chance to talk to them and to explain to them, but I'm an authorized dealer. I can give you a Citizen warranty. You're buying it from Princeton Watch. You don't have a Citizen warranty.
right.
And the watch that you're buying um is now a closeout model, and that's my fault that if I were to constantly get a list of closeouts from Citizen and then remark them in my case, I could have come very close to matching that price, and that was my fault. Although Citizen didn't help because they didn't always send out the list to every customer.
True.
Only certain customers got the closeout list. So anyway, so yes, I made a lot of mistakes. Did you make any mistakes that you learned from and said, geez, I'm not doing that again?
One mistake I made, which I wish I could recoup, is not selling one stock that I bought in 1992, that I bought on the open in 1987, April 29th, 1987. Bought 200 shares of a stock company in 1987. My father's friend, who was on board ship with him in Nam, was a stockbroker for like what was it at that time? Not Merrill Lynch. It was one of the other smaller ones. It was like one I could go in. I could go in and I could say, "Hey, by the way, I want to buy like Milton Bradley or Mattel," and I'd watch the symbol go across as a kid. You go, "Oh, isn't that cool? You just bought stock. That's your stock going across." And that's how you got to see what was going on.
Right.
Um, and so I was like, wow, this is kind of cool. And I told him, okay, I want to sell my Mattel, my Milton Bradley, and my McDonald's, but keep half of my McDonald's and buy all of this other stock. It's going to cost me $5,200. He goes, what? You're nuts. You're buying a stock that doesn't pay a dividend and it's an IPO. That's not good for you. I'm like, listen, you're at a different stage of your life. I'd like to take on a little risk here on this more money, and I'd like to do that. I said, also, for my mother, I'd like to do the same thing. He goes, your mother shouldn't be doing that. I said, put my mother in it with me. Then in 1992, when we had the recession, I said, Mom, we've made a 10 bagger. I said, why don't we take the money off the table at this point? She goes, seems like a good idea. We made some good money. The problem was, if somebody had told me, don't take all of it off, just take a half or the original investment off, I'd have $13 million right now. That's a
That's on.
mistake I made.
Okay.
The stock that I bought was for $5,200 at $26 a share on the open was Microsoft.
Oh,
The original 200 shares are now, if you bought them, it wasn't $26 a share after all the splits. Those original shares are worth about 5 cents per share. And each of those shares, I would have had umpteen numbers of shares. And so what I have learned, being a financial consultant that I am, being a advisor to families to protect them from themselves.
Mm-hmm.
I know how to buy a stock. I don't know how to sell it. So therefore, I'm not going to be your financial advisor who manages your money, but I will be the person who will show you the tax equivalent features between having it wrapped or not wrapped and why you would do that. And I'll let the money managers manage your money properly. And that's the
Okay.
clairvoyancy that I've gotten over 35 years of doing what I'm doing.
Okay. So you're concerned about this AI taking off a chunk of your business. How are you going to compensate for this?
We have used the AI tools to automate and expedite our deliverables to market. We also are doubling down on our expertise that no one else has and highlighting that because we're actually going to come up on May 1st, our 20th anniversary of the company. We're going to have a year with a 20-year banner across all of our marketing that says 20
Mm-hmm.
years in business. That should drive over the next 12 months a lot of potential business for year end and the beginning of next year saying, hey, these are the type of people we want to work with. They've been in business for 20 years. The people that are there, they're going to be here for a while. And we've got a back office of 20 employees as part of a national network who support us at this moment.
Mm-hmm.
So I couldn't ask for anything more in that manner. Um, but at the same time, literally, I mean, tomorrow I could be out of business because no one's knocking on my door. I mean, that's my biggest concern and has been for my last 20 years.
Sure, sure. So if an undergraduate said, I want to do this, how would they go about doing this?
First off, I'd say, have you seen a psychologist lately? Secondly, what is it about my job that you think is fun, that entices you, and would drive you on the days that you don't want to get out of bed? Because literally everybody who's in my business, at least once a week, says, why am I doing this? I could do another job. I could feel more valued. I wouldn't be dealing with the headaches. No one understands what I'm dealing with. This is such bullshit, all that stuff. So it's a lot of head trash in my business. And if a psychologist was to talk to any person, they'd say, you need to talk to yourself kindly because your own voice could be your biggest critic and worst enemy.
Mm-hmm.
And if you can't turn that off, that person's going to keep telling you you're not good enough. You can't do this. You can't get there, etc. Meanwhile, in my business, if a kid was coming in, I'd say, what skills do you have? Do you have social skills? Do you have relationship skills? Do you have technology skills? Social personal skills? And has anybody taught you about the basics of finance? Then what I'd say is take your unique ability, put that together with the friends that you have, and have fun doing it. Because today, unlike when we started out, we would start a business, go into it, work for 35 years, get a pension, retire. Today, the average kid's going, okay, I don't have a job. I don't have a pool of money to start a business, but in the next 5 years, I want to do this and then go on to the next thing, and then do this and go on to the next thing. So, what skills can you learn while you're in high school and college to take and utilize and do something that you're energized about? Like my stepson, who's 17 now, he turned 17 today. He wants to go to Tulane, just like I did. But he's got other schools that we're very interested in because we know Tulane's a difficult school. It's like saying, okay, I don't know if I'll get into it, but possibly, maybe, whatever. But if we don't get in there, are we going to be happy other places? Don't set yourself up for failure. What are your skills? What are you bringing to the table? Well, his mother's been yelling at him. Why do you do this? He loves sports cards. I'll show you something. These are his favorite things.
Trading cards?
These are not just trading cards. These are collectibles. And
Okay.
each of these collectibles has a different value, and they're all put on. They're now, instead of like what you and I used to do, we'd go to Tops and get the cards, get the gum, chew the gum, play with the cards, and do all that shit. That's the way you and I used to do it. Today,
Yes.
today the cards come out. You may get a box, but you need to buy the whole box. And then what you need to do is you need to buy the whole box and then get it put into sleeves. And then the sleeves have to be graded. And if you have them, you have to have them signed. My stepson started out with just the cards. Then he figured out, hey, wait a second. Maybe I can go to basketball games, baseball games, take jerseys, get them signed. He ordered like 100 jerseys for one guy. Went to that one guy, got them all signed, turned around and had it shipped out. He didn't have to do anything with the shipping or anything like that, but this guy did it all. He made the spread. He made I'm the buyer, got the guy to do it. I have the seller, and he made, as the seller in between, the difference. He's doing
Hmm.
exactly that by doing individually getting the signatures done. And so to him, the passion is, I said, why don't we take what you're doing and your affinity for sports and knowing the players and send you towards the NIL market while you're in college? You get to know the players, you get involved. You then hook them up with us. We can get them with the right financial advisor that protects their finances, get them the right attorney that protects their parents from touching the money, that says to the contract people, we're going to take your contract money. Here's your paycheck, your paycheck, and all your stuff that you can have. And then you can build a relationship with these guys over the next 20 years. And as part of being part of my business, you can create that division of what we do. And that
So what kind of a degree do you wish your stepson to get so that he can help everybody to his best of his ability?
there is actually an NIL marketing degree. Then, if he wanted to,
Okay.
there is also at Tulane. Tulane has an incredible law school, and the law school has sports agents. So you can go to Tulane Law School to become a sports agent because they
Okay.
have a hot shot Tulane uh, football team, basketball team, baseball team that they've got a huge NIL program.
Okay. Well, I thank you very much for your time. It's really been a pleasure. It's been educational, even though I didn't understand everything you said. But I'm going to go back and I'm going to look it up and see if I can figure it out. And I will go back to your podcast and I'll take a look at them. So I appreciate very much you spending this time with me, and hopefully it will help out the undergraduates that are looking for a different kind of a career. And I thank you very
If
much.
Well, if they want to go into insurance and finance, there are few places that they can go that are going to be better than this. One of the things I have done is I've helped um, other people get jobs, both out of college. I've placed two kids from Tulane through our study group, and they were very, very thankful. It's one of our favorite things to do. So,
Well, that's great. Thank you
yeah,
very much for doing that.
yeah. My pleasure.
All right. All
I
right.
thank
Take
you
care.
very
Thank
much.
you very
Sorry,
much.
Stan. Okay, bye.
Not a problem. Thank you. Very nice to meet you.